TechnologyOne reported a record profit, and the share price fell. Then, 3 days later, it jumped more than 7%. That sequence is not noise. It is a map of a thesis in transition, and the question it forces is whether the market has priced the new thesis or merely reacted to a broker note. The prior positioning on TechnologyOne rested on a disruption risk frame. The assumption embedded in that frame was that generic AI platforms, large language models deployable across enterprise workflows, would erode the pricing power of vertical software vendors like TechnologyOne. That assumption drove the valuation discount that had kept the stock capped below $30 for much of 2025. Bell Potter's reaffirmation after the half-year results did not simply repeat a buy rating, it explicitly inverted the disruption frame, arguing that TechnologyOne is better positioned to benefit from AI than to be harmed by it. That inversion is the event that matters, not the rating itself, but the repositioning signal it sent to holders who had been underweighting or hedging against disruption risk. The mechanism behind the reframe is domain specificity. TechnologyOne's verticals, local government, higher education, hospital and government agency administration, involve compliance workflows, regulatory reporting, and process automation that generic AI platforms cannot replicate with years of domain training. The company's SaaS Plus model, which owns and operates the full technology stack on behalf of clients, means the AI layer it deploys sits inside a closed data environment the client controls. That architecture directly addresses the sovereign data concern that enterprise buyers are increasingly treating as a procurement requirement rather than a preference. The inversion logic runs further. Because TechnologyOne owns the workflow layer, it captures the productivity gain from AI internally as margin expansion and customer stickiness, rather than passing it to a third-party AI vendor. The company spent $84.1 million on research and development in the half, up 22%. And that spend is directed at embedding AI into existing vertical workflows rather than building a general-purpose platform. The distinction matters for capital allocation. A company that monetizes AI through its own product stack has a structurally different margin profile than one that licenses AI capability for the hyperscaler. What Bell Potter's note did to positioning is more important than what it concluded about fundamentals. Holders who had been carrying disruption risk hedges, either through reduced position size or through offsetting sector shorts, faced a changed cost-benefit calculation once the reframe was published. The 7% move on the day of the note was not driven by new buyers discovering the stock. It was driven by sellers who had been leaning against the disruption thesis, removing that lean. The distinction matters because removal of a short lean is a one-time flow, not a sustained accumulation signal. That asymmetry is what the thesis reset leaves unresolved.
The surface reading of the half-year result is a miss. Pre-tax profit of $89.1 million against Bloomberg consensus of $91.2 million, triggering a 2.9% decline on results day. But that reading is doing something structurally misleading because it treats the miss as evidence of deteriorating execution when the actual signal points in the opposite direction. The key condition here is what drove the gap. TechnologyOne's marketing costs surged from $4.9 million to $14 million in the half, almost entirely attributable to the national showcase event where the company launched its AI product suite. Strip that one-time spend out, and underlying pre-tax profit growth was 19%, above the top end of management's guidance range of 18 to 20%. The consensus miss was manufactured by a non-recurring investment in customer pipeline, not by a shortfall in the core business. Annual recurring revenue of $598 million, up 17%, sits precisely within the company's medium-term target band of 16 to 18%. That band is not arbitrary. It is the growth corridor management has committed to maintaining through to the $1 billion ARR target by 2030. Hitting the midpoint of a self-declared range after 17 consecutive record first halves is not the profile of a business losing execution momentum. It is the profile of a business managing growth predictability. The participant timing asymmetry here is observable. Institutional holders who had modeled the consensus figure sold into the result on the day it was released. Retail and momentum participants who were not yet positioned for the AI product launch narrative had not yet entered. Bell Potter's note, published after the initial sell-off, effectively transferred information from the institutional layer to the broader market, compressing the timing gap between those two participant classes. The 7% rebound happened not because fundamentals changed between Tuesday and Friday, but because the participant structure on the stock shifted. Free cash flow fell 15% to $20.3 million, and that number has not fully been absorbed by the market's AI beneficiary enthusiasm. The cash flow compression is a direct consequence of the $84.1 million research and development spend, 26% of total income, and it represents the single legitimate concern the results introduced. If the AI product suite launched at the showcase event does not convert into accelerated ARR growth in the second half, the cash flow compression will read as investment without return rather than investment ahead of return. The verification threshold for the AI thesis is ARR growth at the top of the 16 to 18% range in the full year result, with the UK operation, currently at $53 million ARR, up 23%, sustaining or accelerating that trajectory as British Council amalgamation continues. The City of Townsville's return on a 10-year contract worth 3 times its previous value is the kind of data point that belongs in the full year verification, not in a half-year read.
The 30-31 resistance zone is not a technical abstraction. It is a price level where multiple prior rally attempts have stalled, meaning it is a level at which holders who bought above it are still underwater, and sellers who exited near it are watching for re-entry. The 7% move on Friday brought TechnologyOne back to $29.84, 1 cent below the lower bound of that range. The capital flow question that the resistance zone poses is structural. Who is sitting at 30-31, and what would make them step aside? The holders most likely to be at that level are medium-term institutional investors who accumulated during 2024's re-rating and trimmed or exited into the April sell-off. For those participants, the AI beneficiary reframe does not automatically change their exit price. It changes their willingness to hold through volatility on the way back up. That is a different flow signal than new institutional accumulation. The counter signal worth naming here is what the resistance zone did not produce on Friday. Despite the 7% move, the stock closed at $29.84 and not at $31. That means the intraday buyers who drove the rebound were not large enough or conviction level enough to push through the overhead supply at $30 in a single session. The participant class that would confirm a genuine breakout, institutional rotation into TechnologyOne as the AI beneficiary thesis displaces the disruption risk frame across the sector, has not yet shown observable positioning. The exception to that reading is the local government vertical, where annual recurring revenue surged 27%. That vertical is TechnologyOne's highest AI integration density segment, and the growth rate is running well above the company's overall ARR band. If institutional buyers are going to build the AI beneficiary thesis into a sustained position, they will look to that vertical as the proof of concept data stream, specifically whether the 27% growth is driven by new customer wins or by existing customers expanding their ARR per seat as AI tools increase workflow coverage. Bell Potter's $32.25 price target implies approximately 8% upside from Friday's close. For that target to function as a capital flow anchor rather than a directional opinion, the full-year result, expected later in 2026, needs to show profit before tax growth at the top of the 18 to 20% guidance range and ARR approaching or exceeding $660 million on an annualized basis. Those numbers are not a forecast. They are the threshold at which the AI beneficiary reframe becomes self-sustaining rather than broker-dependent. The 30-31 resistance zone is where the thesis gets tested with capital, not with notes. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.